Good afternoon, everyone, and welcome to our live stream lunch today. For those of you who don't know me, I am Becky Schaub, the Membership Support and Engagement Coordinator here at the Oakville Chamber. Today we are joined with Matthew Stevenson, Senior Insurance Specialist with RBC Insurance. Matthew will be sharing his thoughts on business succession planning, which includes an overview of recent government changes to corporate taxation, how to withdraw from a corporation without paying high personal tax rates, and how to grow corporate assets while avoiding high tax rates on passive corporate income. Matt, I'll leave it to you, and good luck. Thank you for joining us. And
thank you so much.
I hope everyone joins.
I'm Matthew Stevenson of RBC Insurance. Thank you so much for tuning in. So we're talking today about business succession planning. First up is the recent changes to corporate taxation. So a couple of years ago, we saw what we will call integration of tax rates between dividend and income. It used to be that above approximately $45,000 a year, you would be having an advantage if you paid yourself dividend instead of income from your corporation. But now, once we're above that approximate $45,000 threshold, there's no difference. You'll pay the same amount of tax. So the dividend advantage is actually gone. Last year, the government did an end to what we used to call the family dividend sprinkling. So this would be if you have a family business, one person who works at the company, but all family members receiving income from the company. We'd be getting $40,000 to $50,000 dividends paid out to children, to spouses who weren't necessarily working at the company. Purpose obviously being if you pay $50,000 to 5 people, the overall tax bill will be a lot lower than if you pay $250,000 to one person. But the government did away with the dividend sprinkling such that if you don't work at the company, you don't get to have the dividend. So if you work at the company, you have to be paid only commensurate to what you're actually doing. We can't have someone showing up for one day of work a year and receiving their $50K. It all has to be in line with the work you're actually doing. So that was the end to the family dividend sprinkling last year. And finally, there was the $50,000 cap on passive corporate income. So first we'll want to define this passive income. So if you're a company that manufactures running shoes and you receive money into the corporation for selling those running shoes, that's active business income and that's taxed preferentially. On the first $500,000 of active business income, you're going to be charged about 15.5% tax. And that's as good or as low as a tax rate as anyone is ever going to see ever again. So that's where we want to be. Now the passive income, suppose your corporation also owns an investment property of which you're collecting rental income to the corporation. Or if your corporation has an investment account at a brokerage somewhere and you're receiving dividends from stocks or you're getting capital gains on mutual fund holdings within the corporation, that's passive income as well. So this $50,000 cap, how that plays into things is if you're above the $50,000 a year of passive corporate income, your tax rate could be as high as 70 some odd percent. 70. So that's an awful lot of money to be paying in tax. But if you're between the $0 and $50,000 a year of that corporate passive income, your tax rate on that income could still be about this high. That's the top tax rate for corporate passive income in Ontario. Now what we want to do is turn those numbers into something that looks more like this, don't we? So how do we do that? Now, when corporations are experiencing good sales and good times, the business owner, what they have on their mind is things like, how's my productivity? How are my employees doing? Are they behaving themselves? Are they productive? Is the marketplace changing? How is my equipment? They're not necessarily paying any attention to what's my tax rate on my corporate passive income. So I recommend you talk to your tax professional about what your passive income sources are and how much tax you're paying on it. Now, when that business owner is doing well and they have a little bit more money coming into the corporation per year, then the money really needs to be put to use in the corporation. You don't need more employees, you don't need more equipment, you don't need more space, you don't need more advertising, but you've got a few bucks. Now what do? The business owner is going to want to pay themselves that money and have it in their own genes for their own family purposes. But the problem there is now we may be looking at this number. This, of course, is the top personal tax rate in Ontario. So if you're a business owner who's doing well, you've got retained earnings in your corporation, you don't want to face this number to invest it within the corporation, You don't want to face this number to pay it to yourself. What are we going to do? What's the exit strategy here for your retained earnings? A few things that tend to get used are the RSP. The RSP gets rid of one of the problems temporarily. When you pay yourself from your corporation, put it into your RSP, now you're going to get a tax deduction from that money, and that's going to offset, as I say, temporarily the fact that you're paying income tax to take the money from the corporation. It's temporary because ultimately you're going to pay yourself that money as retirement income, and then it's going to be taxed. And it doesn't get rid of the problem of investment returns being taxed. Because as we know, a dollar that comes to you from an RSP or a RIF is a dollar of income. Therefore, anything that's in that account by way of investment returns is taxed as income. So we've not gotten away from the problem of getting your investment returns taxed. The other one's the TFSA. Now, the tax-free element of the TFSA is your investment returns. Investment returns are not taxed at all in the tax-free savings account. So we've gotten rid of that tax problem, but we still have the former. If you pay yourself money from a corporation to put it into your TFSA, you're paying that personal income tax rate to get the money out of the corp. So we need to have an answer here of how we can get money grown within a corporation, and we need to get money out of a corporation without paying these tax rates that perhaps start with a 5. Now, there is a way to do that. It is an insurance-based corporate investment. And this is what I would love to talk to you about. Matthew Stevenson from RBC Insurance. If you have any questions, matthew.stevenson at RBC Insurance. You can click below right now, and I'd be very happy to hear from you. Thank you so very much.